This is BullionMax, the podcast. I'm Mark Allen, along with Sean Reynolds, the customer service manager for BullionMax. Our guest today is Simon Mikhailolvich. He's a co-founder and the managing director of TBR and is a member of the TBR board of directors. Simon, welcome to BullionMax.
Thank you. Thank you for having me.
We're going to talk about precious metals investing. I want to talk about the economy, inflation, which is on everybody's mind, recession. Let's talk about your background first. You came to the U.S. from the Soviet Union. I think you were around 19.
Yeah. I was 19. We came in 1978. $100 suitcase, no papers. So I have some experience with dispossession, financial and otherwise. But then, I ended up going to college and becoming an investor and spent basically my career up until the last 10 years, the first 30 years in the normal financial investing, mostly focused on credit, private credit, workouts, and then eventually credit derivatives, CDOs that some people have heard of, and mortgages, subprime mortgages, and things of that nature.
Coming from the Soviet Union, was there culture shock?
A lot of people ask me that. There was a culture is a multifaceted notion, right? There's a social culture, there's a business culture, there's a different kinds of culture, intellectual culture. So I would say it's, growing up in Leningrad, which is now St. Petersburg, around museums and theater and reading classics and so forth. I mean, I wouldn't say it was a cultural culture shock because, the United States, particularly New York, is the center of sort of Western culture, as was St. Petersburg, or as is St. Petersburg. But of course, commercially and some social directions, I mean, it was different, and we had to adjust. But I would say that intellectually, it was not as big a transition as one would think.
Interesting. I just have to ask an off-business question. Is there any food that you miss that you can't get here?
There's nothing you can't get here, particularly New York.
That's true.
I try, but there's virtually nothing that you can't get, which is what makes this country so wonderful.
Absolutely.
You have everything right here.
What is your feeling about the general state of our economy? Not only the U.S., but the global economy, the world economy.
I think, look, I mean, everybody who's listening to this, I mean, listens to a million different opinions and inflation, the Fed's can do this, the Fed's can do that. So I think it's probably, to me, it is helpful to just step back from the whole thing and understand where we are in a strategic sense as opposed to in a tactical sense. This is my thinking. I'm not saying that this is the way it is, but the way I see the situation is that we have been in a 40-year financial bubble that has been building over time. This bubble is multifaceted. It has many different components to it. And understanding this and why this bubble is unsustainable is really what led me to become interested in precious metals, which, I'm in my 60s. I mean, that didn't happen until maybe, 10, 12 years ago, 15 years ago, something like that. So what I'm talking about here, the bubble that I'm talking about here, is if you look at all the charts, it's very easy to see. Starting from the early 1980s, interest rates that, because of inflation, because of Volcker raising rates in 81, 82, interest rates started in the high teens. And for the next 40 years, up until literally this past year, with some small interruptions, but if you look at the trend, they've been declining. So you had interest rates going from 20% almost to zero. So people who have any background in finance would understand what that type of a reduction in discount rate does to the present value of future cash flows without anything else happening whatsoever, just from that. We can see the reverse action of that last year when, if you look at an ETF that tracks 20 plus year maturity treasury securities, ticker TLT, was down 30% last year. 30%. So imagine the drive the other way when you go from 20 to 0. Now, of course, the other thing everybody understands at this point is you can go from 20 to 0, but you can't go from 0 to minus 20, which is negative 20% interest rates. So therefore, the ride that we have experienced over the past 40 years is over. It's been over. It's been over really since 2008 in substance, because then the rates have been kept at 0 for 14 years, which has caused all other kinds of problems. So this is just, I don't know whether it's a symptom or whether it's the driver, but this is what happened. And this had tremendous impact on the value of everything. Because when the money is 0, a lot of projects that otherwise would never get done, and they don't have to make money. Frankly, nobody knows whether they make money or not, because there's no cost of capital. And without the cost of capital, you cannot really price anything. So in a capitalist system, in a free market capitalist system, the most important signal that both informs investors and capital allocation professionals' decisions. Capital allocation professionals don't necessarily mean investors, also industrial capital allocation, projects, infrastructure projects, all kinds of projects. So if you don't know the cost of money, you have really no way to decide which projects are profitable and which projects are not profitable. So
there are, Silicon Valley, the tech industry, people come up with a new widget, a new gizmo, a new pen, whatever it might be, and they get all kinds of investment, but they never focus on what you just said, profit.
That's because you're not paying 8-10% a year for the money. Because if you had that debt service, you wouldn't be able to not pay attention. So the part of this bubble was this decline in interest rate. The other part of this bubble was a conscious policy, I think, of the government. What some people call it financialization, you can call it financialism. The simplest way to understand what that is, it's a system-wide optimization of real economy, of industry, of projects, of everything around finance and asset prices. So not the value created, delivered over some period of time, but the price, the present value of this creation quarter as marked by the market quarter to quarter to quarter. And it's easy if you don't need to know anything about finance to understand that if a manager of a corporation or of a business or hot dog stand of anything is worried about what is the present value of his business as marked every day, every month, every quarter, versus what can he build here if he's given 10 years, then obviously it's a completely different program with completely different objectives, with completely different allocation of resources, and so on and so forth. So a combination of financialism, entrenched financialism in everything, the way the companies are run, the way the investments are made, the way everything is trading. People used to save money. Now they don't save money, they invest money. There's a difference between saving and investment. It's a pivotal difference. Gold has a lot to do with it. Savings, I would define as deferring consumption, setting aside purchasing power towards using it in the future and preserving it over this time in a way where there's minimal risk to principal. So in other words, without capital risk.
When there was little cost to money, there was a lot of things getting done because why not? No big deal.
Exactly.
But now we're starting to feel it when it's time to do something. And so it's since the money isn't so cheap, it's not so easy to do everything you want to do now. Now you have to pick and choose and try to consider what's going to give you the best return on your investment.
That is very true. But also, what it means is that legacy investments, credit moves slowly. In credit, if rates go up today, tomorrow everything doesn't blow up because there are refinancing schedules, there's debt service. Companies have to pay a little bit every month. So, having been in credit, I know this dynamic. There's a significant lag effect. But not only do you have to choose projects, all the legacy projects, everything, all the stocks, bonds, everything is going to get revalued. It's already getting revalued on a mark-to-market basis, but it hasn't yet been revalued on the credit sustainability basis. We haven't seen a credit cycle, which would be the result of higher cost of money, where previously outstanding loans may not be able to be paid. So this brings the issue of counterparty risk. Major counterparty risk, something that people have not had to deal with, I don't know, in decades.
Sounds like we're feeling it. Even these things that we didn't feel previously, they're still alive. And so now they have a cost that they didn't have previously. And so it's almost like Judgment Day is coming, whether or not they can continue down that path, or certain things might get discontinued, just if they're not worth the squeeze of the juice anymore.
Well, that's the genius of the capitalist system. And this is not a song for the capitalism. Capitalism has a lot of different issues about it. But one of the effective, the positive things of capitalism, painful but positive, is that it very quickly excises excess, mistakes. So mistakes get made, companies or projects fail, the money is recouped, whatever salvage is recouped and redeployed into something better. So when you have a 40-year sort of the stagnation bubble, whatever you want to call it, financialism, with bailouts and nobody's allowed to fail, what you have is a tremendous amount of misallocated capital that is not defaulting, that is continuing to take up resources and space. And we're going to, I believe, see that undone significantly over the coming year, 2, 3, 4. It's unclear how long it will take. But that, I think, is coming.
I'm going to take just a brief time out and ask Sean, what are people asking you about as they call into BullionMax right now, as we begin, the new year?
Right. We've got some people who are concerned about the death of the dollar or the onset of digital currency, and they're frightened of it. Frankly, they don't. Since it's not even fleshed out, there's a lot to be afraid of because there isn't much information out there. Well, one thing is for sure is people like the idea of gold and silver because it's money you can hold, and it's always going to have a value regardless of what happens. We're never just going to throw gold and silver in the ocean and say we're done with that. It's valueless. It's not good for anything anymore. And so it's a good place for people to start who have those concerns, whether they're valid or not valid, who knows? Only time will tell. But that's the type of investing I'm helping people with, is getting them started with what they can afford, what are some good choices for them to get them as much metal for the money, and go from there.
Our guest is Simon Mikhailolvich. He's the co-founder and the managing director of TBR. And we are talking about the financial markets as it relates to precious metals. Do you think, Simon, that the Fed is doing a good job in keeping interest rates jacked up, or should they let it fall again? Yeah.
You're asking me, is the Fed doing a good job being a central planner?
Yeah.
I mean,
why not?
Well, no, how are the results? How are the results? Are they doing a good job? We have, everybody says there's 8%. Everybody says, I'm told that there's 8% inflation. I went and ordered Chinese the other day. And when I did that, I pulled the, like we do, the menu out of your drawer, kitchen drawer, where you have the menu. So I ordered, and then I went to the restaurant to pick up. It was lunch. The menu said it was $10.95 for lunch, just for one lunch. I ordered several lunches. I went there. It turns out they're $15 a piece. So the menu that I had in my drawer from, I don't know what it was, from last summer or last spring or whatever, prices are up 30, 40%.
Mhm.
So I don't know about 8% inflation, but I think I would like to pick up on a point, if I may, that Sean made about, gold and precious metals always
Sure.
having value. I think if people say that, I don't know that everybody understands why that's so, because there's a lot of pushback from sort of modern people, particularly enamored with cryptocurrencies and financial investments, and say, well, gold is passe. I think what's important to understand is that gold, uh, gold, silver is a little different, but let's talk about gold for a minute, because gold is a global reserve currency used by central banks. Um, so what is it about gold why do we say that it's always valuable? What is it about it that it's still here after all financial assets have come and gone, and they have all come and gone? I mean, look around you, find an investment that's more than 100 years old, financial investment, and it still exists. I mean, you may find a few, but in the trillions of dollars of outstanding investments, yeah, I don't think there are too many of them. And I think what it boils down to is gold has certain properties that no financial asset has. And the demand for these properties is usually not high during bubble periods like we have been through, because demand for safety, nobody questions FDIC insurance. It's just there. We take it for granted. We don't need to think about it. Well, a lot of people have taken for granted, for example, that some of these crypto exchanges were completely safe because they're used to that. And then it turned out that that wasn't quite the case. So what gold and silver bring to the table is that they are nobody's obligation. So, like, neither silver nor gold do annual reports. They don't have disappointing earnings. They don't have a management team problems. They don't have a business plan problems. They don't have any of these things. It's just a piece of metal. It's a piece of metal that's scarce, that's permanent, and that is independent. And independence is very important because there's no other financial asset out there. Because all financial assets are somebody's obligation. Somebody's promised to do something. It's your share in a company that promises to execute a business plan. It's your bond. Is somebody's obligation to pay you interest and principal over some period of time. It could be a derivative that requires somebody to perform if something happens. All these things are promises. See, gold and silver are not promises. They are what they are. They're elements. They're primary elements. They have certain physical properties, and they're here today, tomorrow, and they're virtually indestructible. And they're independent because they don't depend on the financial system. Unlike cryptocurrencies, for example, they don't depend on mining or networks or access to the internet or access to the electricity, or there being incentives for anybody to do anything. All of the gold ever mined still exists. Gold is not mined to be consumed. Gold is mined to be owned. So all of it still exists, and every ounce of it is owned by somebody at all times. The new supply only adds, I don't know, it's like a couple of $100 billion in like at today's price a year, which for the whole world as a reserve financial asset, that's not a lot. And that's only maybe between 1.5% and 2%, I think, of the outstanding inventory is added every year. So you can think about it. I mean, think of a market where 98% of inventory is there already. It exists. So even if tomorrow the mining stopped, it would have no immediate, I mean, it may increase the price because of the additional scarcity, but it would not have a material immediate impact on gold, transactions with gold, or anything to do with gold. So it is these properties of independence, of scarcity, because there's only one gold, there's only one version of it. It has a unique molecular structure, and it cannot be replicated. And luminaries as famous as Isaac Newton have tried. Isaac Newton, by the way, was an alchemist. I mean, he devoted a significant portion of his career to trying to create gold out of base metals, unsuccessfully. Right. And so gold cannot be replicated, and not at the cost that makes any sense. I think in a reactor accelerator it can be, but it's not feasible. So in a feasible way, it cannot be replicated, and it's lasting. I mean, gold does not get destroyed. Paper gets destroyed, silicon chips get destroyed and degrade. Gold does not degrade. So that is why gold is still valuable after all these years. It is these independence, permanence, and scarcity are the qualities that make gold valuable and continue to be valuable.
investing in precious metals, specifically gold, is that for the wealthy? Is it for those who don't have a lot of money, or is it for everyone?
So investing is gold is not investing. That's where I was going with the difference between savings and investment. It's saving. There's a difference between saving and investing. Investing is risking principal in order to increase purchasing power. It's taking risk in order to generate return. Saving is setting aside a certain purchasing power without risking principal or with minimal risk to principal, with the idea that it can be retrieved down the road and spent without it losing whatever the savings vehicle is losing purchasing power. So gold is not an investment because it doesn't increase. It doesn't increase. Its price may increase, but gold is gold. It's the same thing. So you're not getting quote unquote a return. What you're getting is a promise that it will always be valuable, that it will never default on its obligation, that that's why it's a reserve asset. I mean, the concept of a reserve, we set aside reserves for when we need them. Doesn't mean it's a global emergency. It could be your personal emergency. Mm-hmm. It could be this is where, suddenly your savings are gone, or, you gambled them, or whatever happened, divorce or whatever. Then you have this asset that is virtually indestructible and whose value fluctuates, but as accountants say, there's no risk of permanent impairment. In other words, unlike a bond or a promise that can be defaulted and you never can recover the money from it, gold doesn't default, so the price may go up or down, but the piece itself is always there.
Sean and I did
it's not for you, for your children, your grandchildren, whatever. So no, it is not for rich people, it's for anybody.
It's for everyone.
Of course.
Sean and I did a program at the beginning of the new year talking about that buying gold and silver and precious metals is not like buying real estate and flipping it. You can't buy it today and flip it tomorrow because it goes up, a quarter or an ounce, or a couple of bucks. Is buying gold and silver a long-term, I'm going to call it an investment. I'll call it a buy because you don't like the word investment.
Long-term savings opportunity.
Good one.
Well, look, people speculate in gold like anything else. I mean, you can speculate on gold prices or silver prices or pork bellies. People normally do it with leverage, and they do it through financial instruments. Absolutely makes no sense to buy physical gold and silver if you want to speculate, because the friction costs are too high and it's not convenient, and that's not what it's for. Physical gold is like I said, because everything I said about gold, about independence, about scarcity, it doesn't apply to gold derivatives. I mean, there's no scarcity of gold derivatives. It's all a question of leverage. I mean, the more you can increase exponentially the amount of derivatives outstanding, if you're willing to accept more leverage. That's exactly what's happening in the paper markets, in gold and silver paper markets. If you want independent, and of course you're not independent because those instruments operate within the financial system, and they're subject to whatever disruptions or issues the financial system may have. The principle here is you don't plug your backup generator into the grid. I mean, nobody does it. Nobody would think to do it, except in finance. Because in finance, investors use hedges, they think they're hedges, which are just another derivative instrument. So, of course, it works under normal circumstances, potentially, so long as the correlations hold up, but it doesn't work like it didn't work in 09, in 08, because if the market is disrupted, then you can't collect. So physical precious metals are savings / reserve / whatever you want to call it, rainy day funds, or intergenerational savings, where for grandchildren and children and christenings and bar mitzvahs and whatever, people do that. It's for the long term. It's not for short term speculation.
Got it.
And if you own it yourself, yeah, go ahead. That's it.
I'm sorry. When we started, I said I was going to start our chat by asking you what you meant by being a contrarian investor. And I think that's a good place for us to wrap up. Why do you consider yourself a contrarian investor?
A contrarian is a person who does something the majority of people are not interested in doing. My investment career has only had several successes, and they all came around buying things that everybody hated, like distressed CDOs or insurance on credit in 2006 and 7 when you couldn't give it away. So I became interested in gold because I felt that there was a tremendous systemic risk, which is now coming, I think, more into focus. But when I first saw it, I don't think people realized it at all. But as it's coming into focus, I realized that there was this tremendous systemic risk in the financial system, that this bubble that we've been in is going to have to be reorganized and restructured. And that would cause tremendous destruction of perceived value, because the value is not real, it's perceived. Just like in a lot of cryptocurrencies, we found out that the value was perceived and not real. And that got me interested in gold, which nobody else is interested in. Now, you say, well, BullionMax, you have people call you, some people call us for gold, but it's a tiny number of people relative to people who are calling their stockbrokers and other, Vanguard and other people. If you look at the ETFs, gold-backed ETFs in North America, I looked just the other day. If you not look at the price, but the tonnage, in other words, how much gold by weight is in those ETFs, exchange traded funds, it's less than it was in 2012. So why am I contrarian? Because obviously I'm interested in something, which is this gold and silver, that the mainstream has no interest in. So to be successful contrarian, you have to be early, because it's just like buying insurance. If you want to buy insurance and profit from it, you can't be buying it when everybody sees the risk. You have to be buying it when the insurance companies can't give it away, because nobody sees the risk. That was credit default swaps in 2006 and 7. They were losing money because nobody wanted insurance. Everybody wanted to sell insurance. They thought that this party would never end. So I'm essentially in the insurance business this time around again, like I was with credit default swaps in 2006 and 7, with cheap insurance, which I think is grossly under-demanded and undervalued.
Do you think, in our remaining couple of moments, is this economy different? Is it unique? We've never experienced anything like this before. I mean, the other downturns in the market, in 2008 and other times, it seems to me to be totally different right now. I was at the mall, and I use this as an example. I couldn't find a place to park. People are running in for now after Christmas sales, and they're spending. The economy appears to me to be booming. Am I wrong? It's so unique to me.
Well, there's a difference between income statement and balance sheet, right? Let me give you this example. If I give you an American Express card, I say, Mark, let's give one to Sean too. Gentlemen, unlimited credit line. Go at it. You're going to be in silk stockings, as they say. I mean, you're going to be spending money. You're going to be going to fancy restaurants. You're going to be buying with yourselves, fantastic cars. Your economy would be booming. But what's happening to your balance sheet? It's getting destroyed. So the magic of these last 40 years have been the ability, particularly in the United States, to seemingly endlessly subsidizing consumption with credit. It then became necessary to make that credit free, to continue to grow it.
Mm-hmm.
So while it may look like economy is doing well, it's not real. It's real as far as it is. It's just like your spending on that American Express card would be real, but it wouldn't be sustainable because at some point that card's going to get cut off.
But at
Now,
the
of
end
course,
of the
in
month,
this-
you have to pay the bill.
Let's say you didn't have to pay the bill at the end of it. See, this is the thing. This has been going on for 40 years. We have not had to pay the bill. We just keep rolling it into, we keep refinancing into a new credit card. And then to a new credit card, we just consolidate, roll forward, and not pay again. And this is what's been going on. If you were to look at the debt service of the government from the late 90s, it was the same 5 years ago as it was in the late 90s, with a debt how many times more? Now that the rates are up, it's going up very quickly. But up until then, like, we kept accumulating debt and nothing. So when you say all these things about the economy, you're looking at the income statement. You're not looking at the balance sheet. So since I have background in credit, one thing I learned is in the end, it's the balance sheet. And you can't fix a broken balance sheet without actually fixing it. In other words, somebody has to lose money because every dollar of debt is somebody's asset. Every dollar that somebody's borrowing, somebody thinks it's their investment. So if these debts cannot be repaid, then somebody has assets on their balance sheets that are not worth what they have them on their balance sheet for. And who are these people that we're talking about? We're talking about savers, we're talking about pensioners, we're talking about pension plans, talking pension funds, insurance companies for which all the annuities and life policies and all these other things get issued. It's us, the people. I mean, these insurance companies serve, these are the policies of the population. So the taxpayers. So we don't realize that, but essentially, we are the ones whose assets are overvalued relative to the ability to collect. So when you look at the economy, yes, on the credit card, it's doing great.
Got it. We are out of time. In a couple months, will you come back and give us another update?
Sure.
We would
Happy to be.
We would like that. Sean, thank you. Real quick, anything, what are people asking you right now at BullionMax as they look at the website and as they call in?
It's mostly new people who are getting into precious metals for the first time. And part of it's, how does this work? Part of it's, what do I buy? But really, as opposed to telling them what to buy, I educate them instead. And then I have them tell me what they should buy. I don't think anyone should buy anything because I said so. I would hope to educate you so you know what you should be buying.
And that's really the mission of BullionMax. I thank you, Sean, and thank you, Simon. Look forward to our next conversation. And we thank you for watching as well. We appreciate your comments. And if you click the subscribe button, you'll get the latest information, as Sean just pointed to, the button here on YouTube.
Click the button.
I'm sorry, what was that, Sean?
Click the button.
Hit the button.
Subscribe, please.
Simon, again, thank you. Hold on. I'm Mark Allen for BullionMax. We'll see you next time. Bye-bye for now.